Okay, chapter 3, problem number 2. They give us a bunch of information here, and this problem is called exercise 3.7 in your textbook. Just problem 2 on Connect, and they gave us some information. I'm going to go through and highlight the important words first. Purchased on account. No cash went out. Purchases were FOB shipping point, which means the minute they were shipped, they belonged to the buyer, and the buyer is going to pick up the freight charges. They returned $2,600 on account, so the amount that they owe goes down. They agreed to keep some other, but they get an $1,100 allowance. That means the cost goes down. They sold merchandise that cost, so our inventory went down. For cash, our cash went up. Delivered the merchandise to customers in the above event under terms FOB destination, which means we own them until the customer signed for them. It also means we get to pay the shipping. And the last event says we paid $8,000 on the merchandise that was originally purchased back in event number 1. And event number 1, as you now know, is not really an event, it's a transaction. Now, they give us some opening balances because they want us to fill out one of those charts that you all love. So let's fill out the beginning balances and go through and do what they want us to do. So the beginning balance in cash, $16,000. The beginning balance in inventory, $8,000. So that's what we had before we bought anything else. We had no beginning balance in accounts payable. We did have $20,000 in common stock. And we had $4,000 in retained earnings. That's income from a prior period that we earned, recorded, and didn't give back to our shareholders. So we have $4,000 in retained earnings. Okay, let's go through the items line by line. So, number 1, we purchased on account $15,000. So that's purchased inventory. So that's $15,000. Our inventory goes up. And we put it on account. So our accounts payable, we owe $15,000 more. We also have this $800 in freight. Okay? So that gets added to the inventory. The cost of getting something to the inventory, all the costs needed to get the inventory to its point of purchase are added to the inventory. So we have $800 in cash that goes out, and that gets added to the inventory. And they tell us that freight cost $800 cash. What you had to catch was this was FOB shipping point. So the minute these goods were shipped, they were ours. we had to pay for the shipping. Okay, the next transaction is they sent back $2,600 worth of stuff that was messed up. Okay, now we hadn't paid for it yet, so our accounts payable goes down $2,600. Because I'm assuming that if you're taking something back to the store, you're not inclined to pay for it. So we returned our inventory, $2,600. So our inventory goes down. And I'm hoping as we go through this, you're starting to see that there's kind of a common sense to it. Okay, they agreed to keep damaged merchandise for which the company received an $1,100 allowance. So the accounts receivable went down. That's an allowance. But the value of our inventory also went down. Now, I don't want you to think that's a bad thing. It means that our inventory cost us less. It doesn't necessarily mean we have to sell it for less. It just means we paid less for it. Okay, they sold merchandise that cost $15,000 for $31,000 in cash. Believe it or not, these are really two different transactions. So first, let's handle the sales part of it. The sales, they got $31,000 in cash. They don't give us a revenue and an expense account. They say do everything to retained earnings. So we'll say, okay, we'll play your game. $31,000 retained earnings. But you all know that that's revenue minus expense, which equals net income, which goes through our little funnel down here to retained earnings. They're just saying, don't mess with all that, just go right there. You can do that. Now, the second part of this is the reduction of our inventory. We don't have it anymore. We sold it. So the inventory went down by the $15,000. And that's an expense. And again, we know that it's an expense that goes to net income that then goes to retained earnings. They say, no, take it right out of retained earnings. So we say, sure, why not? You're the boss. Now, we delivered the merchandise. We sold this stuff here. We're talking about this stuff here. This transaction here. We sold it FOB destination, which means we owned it until they signed for it. That's what FOB destination means, which also means that we get the privilege of paying for it, paying for the shipping. So we have that $500 in cash. That's an additional expense to us. So that reduces our cash. And again, it's an expense, so it reduces net income, but they say go right to retained earnings. So we'll play along. And then last but not least, we paid $8,000 on this transaction. So when we pay, remember the magic word pay means cash out. And because we paid some of our accounts payable, we now owe less in accounts payable. So let's add those up and see what we get. Our total cash, if you add up all those gazintas and gazaltas, you come up with $37,700. No, I'm not that good. I'm not doing it in my head. I have a cheat sheet in front of me. I worked it out before I started recording. Same with inventory. You total that column, and our inventory is $5,100. Our accounts payable is $3,300. our common stock, there was no change to that. And our retained earnings, we started at 4, excuse me, and we increased it by 31 and then decreased it by 15 and 5, giving us an end of 19,500. That's the long part of this problem. We'll finish it up in part 2.